Hi, and welcome to this launch episode of the Align podcast. My name is Gurpreet, and I will be the host for this podcast. Align podcast is your go to resource for expert insights in risk advisory, data, and AI. So join us for thought provoking discussions, workshops, and demos that will elevate your understanding and decision making in the space of data, AI, and risk advisory. Hit subscribe to get notifications of future episodes. In this particular episode, we are taking a deep dive into the supervisory statement by the Bank of England regarding model risk management principles for banks. This was released by the Bank of England in May 23 and will become effective from May 24. And to cover this topic in detail, I have invited Dennis Henderson to this podcast. So, Dennis has more than 30 years of experience and is an expert in risk advisory for banks and financial institutions. Dennis is a partner at Align and he's the director of risk advisory practice at Align. Here's a quick summary of what you will learn in the next 30 minutes. So, you will understand what is in this supervisory statement and how it affects your bank. Also, how to get ready for the May 24 effective date, understand the key challenges and how Align can guide you through these updates, and finally, where you can find more information and stay up to date. This episode is packed with information and insights, especially covering the supervisory statement by Bank of England on model risk management principles for banks. So let's get started and talk to Dennis. So, hi, Dennis. Thanks for joining us on today's podcast episode, and thanks for giving your time. So, we're going to cover the supervisory statement that Bank of England released last year, May 23, which regarding the model risk management principles for banks. And let's get started by understanding what is model risk management. Just a quick intro to what is model risk management.
Yeah, sure. So thanks, Gurpreet. Really appreciate the time today. Model risk management is something that may not be completely new to people operating the financial services sector. I think that we use models a lot in day-to-day life to predict the outcome of things, to inform trading strategies, to, imagine how long people are going to live and how much insurance is going to cost and all of these things. So models day to day are becoming far more involved in decision making, and I think that's only going to become more so as we move to wider adoption of artificial intelligence, because many of those applications are dependent on models as well.
Perfect. Thank you. So it looks like models are everywhere. So
indeed.
So in terms of this Bank of England supervisory statement, what is the significance of this for the model risk management?
Yeah, so the Bank of England has been talking about this for a little while now. Prior to the supervisory statement, they'd issued some consultation papers and so on. And I think the final supervisory statement hasn't actually changed that much from what they had put out in a sort of draft form before. The significance of it is the Bank of England, and through the sort of enforcement arm of the PRA, now has a formal expectation about what banks are going to do in relation to model risk management. They've sort of defined the strategic approach and the underlying principles, and therefore when the PRA come in to inspect any member firm, they will be able to expect that the banks can demonstrate their compliance with the supervisory statement on demand. So the PRA can come in and say, show me how you're complying with this, and if they're not satisfied with that, they will have findings, and the firms will have to remediate that in short order. So That's fundamentally the significance of it.
That makes sense. So let's actually try to understand what are the key changes that have been introduced in this statement. So can you just quickly touch upon what are the key changes that are part of this supervisory statement?
Yeah. Yeah. So the supervisory statement basically is underpinned by 5 principles. And it's actually quite detailed about what's involved in complying with those 5 principles. But if I just run through those, the 5 principles that a firm is expected to have adopted to be able to demonstrate compliance are, firstly, model identification and model risk classification. So what that means is a bank will be expected to have defined what a model is, what the scope of the program is, to have identified the models that are in use and to have an inventory of them, and to have assessed the significance of those models, both in terms of complexity and impact. The second principle is governance. So the expectation there is around how they've defined the oversight, what the culture in the organization is, and this is kind of where they expect to see the tone from the top around model risk management being correct. They'd be looking for how that ties back to risk appetite. They'd be looking for board approval of any policies and well-defined accountability for who is overall responsible for model risk governance. The third principle is around model development, implementation, and use. So the expectation there is that the firms will have processes and standards within the organization, which will look at how models are designed, how they're implemented, how you assess the performance of them, the testing that you do to make sure that the outcomes are what you expect, that the assumptions within the model are valid, and how you identify the limitations and weaknesses of those models.
Okay, so
Yeah, the fourth
and there's still more, I guess.
yeah, 2 more. So principle 4 is about independent model validation. So this is basically saying that although you have the day-to-day processes which look at how you're managing and controlling the models and looking at the outcomes, they would also expect some independent review of the development and use of the models and to see some effective challenge to how they're being used. And then the last principle is about model risk mitigation. So this is about what do you do when models are underperforming? How do you control and review adjustments that might happen after the model? So those are the 5 principles that they have to comply with. There's additionally 4 underlying sub-principles that apply to the firms. So very briefly, those are that the effort should be proportionate. So, a tier 1 bank is going to be expected to have a lot more formality and complexity in their processes than a small bank with limited model use. There needs to be responsibility to the framework that ties to the senior management function. So that's sort of tying very much in with the senior manager regime in the UK and who's accountable. There's an expectation that the effectiveness of model risk management will be reported to the audit committee. And lastly, that the risks associated with AI and machine learning will be included within the scope of the whatever framework you put in place.
So there's a lot of things that to consider in there. So thanks for sharing those
Yeah,
5 key principles and the sub principles in there.
yeah, and just to emphasize that although that sounds a lot, the actual supervisory statement actually has a lot of detail around what's expected there. So there is reasonable guidance coming from the PRA.
Okay. So for somebody who's listening in today, for them to understand based on all these principles that you shared and the sub principles that you have shared. So what are these changes in terms of how are these changes going to impact the day-to-day operations of a bank, basically?
Yeah. So what you would hope is that in many cases, because model risk management's not a new um, discipline, that banks will have many of the processes in place that they need to have already. They will already be thinking about how they use models and um, testing, certainly the most important ones. Um, but I think what you may see is organizations needing to put in place much more formality around their processes, um, better evidencing of what they're doing, because obviously when the PRA comes into review, they'll be expected to provide the evidence on demand. Um, so I think that's often where organizations fall down when there hasn't been a regulatory imperative in the past. So I think that will be the biggest impact.
Okay. So, and when considering those sort of impacts, so what are the potential challenges for banks when they are looking to implement these changes?
Yeah, so I think this is where many of the programs that are put in place to comply may face their biggest challenges, which is, if you like, the discovery process. I know from several of our clients that one of the biggest problems they've had is identifying all of the models within their organization, that their existing inventories may have um, potentially only identified half of the population of models within the organization. So that's kind of where it's really key that they've defined very well what they mean by a model, so that during that process you can get people within the different parts of the organization to identify the things that need to be inventoried. I think once you've got the inventory in place, putting some of the other processes that are downstream in that becomes much easier. And I think one of the things we often see as a challenge as well is around evidencing. Um, and again, this is not a new problem. I think many times I'm think even if I think back to SOX in sort of 2004 or 5, many organizations had the controls in place, but they weren't evidencing them well. And many of the challenges become around how do I evidence this enough so that when the regulator comes in, they could easily see what it is that they're doing and provide the regulator with what they need.
Okay, that makes sense. So now considering all these challenges and all these impacts that will have on the banks, and based on your experience working with banks,
Mhm.
how does Align actually help banks navigate these challenges that are associated with this new supervisory statement that is coming into impact May 24?
Yeah. So we can help. I think a great place to start is assessing the current state and looking at the maturity of existing processes. So what we're able to do is with our clients is look at how well are they meeting the existing requirements, how close are they to where they need to be, and what's the gap analysis. Um, what are what are the main things they need to address, and what are the priorities of those? We can then assist with the remediation where required. And lastly, we can help with the technology implementation. Um, Obviously, at the lower end of things, maybe people are using Microsoft Office, Excel inventories, SharePoint, email, Word being used to document what they need to do. I think as you go through um, the spectrum and become more complex, that often is not adequate. But there are some really great technology solutions there to manage the inventory, tie it into your overall risk management processes, validate and test models, et cetera, et cetera. So, whether that's through our partner IBM or through other technology solutions, that's also somewhere that Aligne can help. And it's not just about implementing the technology, it's about making sure those solutions fit the business requirements and the business processes.
Okay, and just to understand this a bit more in terms of the implications, and so does this apply to all types of banks, or are there any specific types of banks that will be more affected with these changes?
Yeah, so essentially anybody who's regulated by the PRA, the Prudential Regulatory Authority in the UK, is covered by this statement. So that's all UK incorporated banks, building societies, and PRA designated investment firms, where they have internal model approval to calculate regulatory capital requirements. So I think, you know, that pretty much is all of the banks in the UK. But yeah, that's kind of quite clear in the scope to the supervisory statement.
Okay, and in terms of the implications, so if a bank is non-compliant, what are the implications of that for a bank?
So it's hard to quantify because there are no specific penalties within the supervisory statement, but the PRA will expect firms to be able to demonstrate their compliance. I think most banks are familiar with being reviewed by the PRA and what the implications of the PRA having findings is. And failing to deliver on those can have serious consequences both for the firms themselves and individuals. It can lead to fines, and it can lead to censure for individuals, and it can lead to reputational damage. So these are all kind of significant things. I mean, even just in the media this morning, there are reports of one of the big UK banks having just been fined £60 million by the PRA for failing to protect customer assets, even though no customers were affected by the internal process failures of the bank. So even though no customer was impacted by their failing, that still ended up with a £60 million fine. So the consequences of not meeting the PRA's expectations can be significant. And this is why whenever any of our clients have PRA findings, there are always significant projects that are spun up with the highest priority to meet the requirements. And often that can be quite costly and time consuming. And it's the whole principle, it's easier to fix something beforehand than to do the remediation afterwards. So it's always more costly and time consuming if the regulator comes in and has a finding and you have to correct it than if you get your processes right before they come in.
As they say, you know, the old saying, a stitch in time saves nine. So better be
Yes,
prepared ahead of time. So
exactly.
considering, so you, now that you have shared what are the key principles, the impacts, the challenges for banks, now considering all those things, how can banks prepare themselves for this upcoming change that will be implemented from May 24?
Yeah, so I think obviously May 24 isn't very far away. The supervisory statement came out in the middle of last year, so banks basically had a year to comply, and we're more than halfway through that timeline. I definitely see some of the clients forming a position that it's not necessarily that they have to be compliant by May 24, but they need to demonstrate how they will become compliant and have all the appropriate plans in place. That's definitely a risk because I don't believe the PRA have given that indication themselves. But nevertheless, I think if you find yourself going today asking yourself how you're going to do what you need to do, I think it is starting with that gap analysis. I think really being able to get that assessment of where are you in terms of your state of compliance, and therefore what do you need to do, and what are the biggest priority things you need to deliver. I think that has to be the approach. So then you can have the remediation in place, and I think that there is probably some element of truth that if you have a remediation plan in place and are through it when the PRA come in after May, they'll probably look more sympathetically on that than if you haven't done that. So yes, my advice is very much about doing the current state analysis and working out what your remediation plans are.
So thanks for explaining that, Dennis. So now that we understand especially what this supervisory statement includes, how it impacts, what are the challenges, but in terms of the bigger picture of the risk landscape, how does this model risk management and this supervisory statement impact the overall risk landscape for banks?
Okay, so I think if we look at what the PRA and the Bank of England are trying to do with this supervisory statement, the risks around models have been apparent in the financial services industry for a long time. So those risks are still there and very real. And I think they're only growing. I think we've become more and more dependent on it over time. We can see just in recent years how significant it's been. I mean, just look at the COVID years we've had, where many of the policy decisions were made on the basis of modeled data. So that impacted the lives of all of us. And this is also very true in the financial services industry. I think that's only getting bigger with AI. AI and machine learning, very heavily dependent on models, and as we move into generative AI with large language models, even more so. And these models bring us new challenges. So in the past we've talked about problems with models around drift and bias. We have a sort of in AI the new concept of hallucination, and these are all things where there are definitely challenges around how models work, how effective they are, and importantly how they're used. They may be absolutely valid under one set of criteria, but if the market moves or your underlying assumptions are not correct, then the model may no longer be valid and may no longer work. So that's always been the case, and it's very important. The changes here, I think, are ultimately intended to make sure that banks deal with those challenges better. That the risks associated with models are clear within the day-to-day activities. When banks are looking at the resilience of their important business services, they should be thinking about the impact of models on those services, and having good, formal, well-documented and evidence controls over those leads to managing that risk better. So I think that's the intention of the supervisory statement, and that's what the Bank of England is looking for its members to achieve.
Okay, that makes sense, and we all are familiar with what happened with the models and COVID, and let's not go there. But in terms of in terms of the use of technology to implement these new principles, so what role does technology play in that?
Mm-hmm. Yeah, so there's a few different ways that technology solutions can come into it, but just to cover a couple of them. The first would be where you have the volume and complexity, maintaining a model inventory, and providing the processes, workflows, documentation around the risk assessments of those models. So at the lower end Organizations can do that in Excel. As they grow, you start to need dedicated software to cover that activity. And then that leads us on to the second thing, which is integration with broader risk management activities, right? So, I referred earlier to important business services. As banks assess their important business services, they need to think about the other things that impact those services, like models, but also things like vendors, IT assets, etc., etc. So it's no surprise that most of the vendors of integrated risk management systems have a model risk management module. And one of the key things there is being able to tie in your risk assessments of the models to your other risk management activities. Then I think the third area where technology becomes really important is around the validation and monitoring of models. So how are we doing the back testing? How are we assessing drift and bias? How are we doing that on a continuous basis? How are we creating the alerts and notifications when models go out of their range and are starting to produce results that are not what are desired? So again, specialist software covers that, and you want that to then be integrated into your risk management repository and be able to show what's impacted when something goes wrong, what's impacted by it.
That makes sense. And just thinking from stakeholders' perspective, in terms of the, just looking beyond the compliance with these principles related to model risk management, are there any benefits to banks in terms of implementing this, just looking beyond compliance side of things?
Yes, absolutely. I mean, I'm a firm believer that risk management has a bottom line benefit to organizations when done well, because the risks are not just about compliance. When these things go wrong, they can have bottom line implications, whether it's, as a result of bad lending decisions or bad trading strategies or mishedging and these sorts of things, can result from poor risk management around models. So I think fundamentally managing your risks well, making sure that you focus your efforts on the models that have the highest complexity and the highest impact, means that you actually focus your resources where they're most needed. And the impact is about what's the impact on your business, not just about what's the impact of compliance. So yes, I very much believe that there is a business benefit to going beyond the basic compliance here and making sure it's an embedded part of your day-to-day risk management. I think the other thing is that, again, we've touched on AI a couple of times, and model risk is key to AI governance, and we are going to see legislation coming on AI governance. So I think the foundations you put in place in response to this supervisory statement can then lead to a good foundation for future work around AI governance. And we know that regulators around the world are getting very excited about AI governance.
Okay. And in terms of, it's like being compliant and staying competitive, there's a bit of a balancing act. So how can the banks stay competitive while being compliant with these changes?
Yeah. So following on from what I was saying earlier about there being a business benefit, I think one of the key ways to realize that business benefit is for your risk management activities to be embedded in your day-to-day activities and not to be just a sort of bolt-on piece of work. I know in many organizations that risk management processes can be seen as a real admin overhead, but the reality is when this is done well, and I've seen it done really well in some firms, the actual control activities and monitoring needn't be any particular extra work, because people still have some underlying processes. They still do month-end meetings and have checklists and these sorts of things. So the challenge is, how do you make that an efficient process? How do you embed it within activities you would be doing anyway? And that's, I think, about giving people the tools to do so, and enough thought into designing processes and how you monitor the underlying controls becomes really important. Of course, having that in response to well-defined risks. So again, having assessed the impact and materiality of your risks, and having a control response that's commensurate to the risk, and then having the monitoring of those controls embedded in your day-to-day processes. That's the nirvana at the end of this. And if you can achieve that, then you can be very competitive, because you're managing your risk really well, and it's not taking a lot of effort to do it.
Yeah, and I believe it's not like a project; it's an ongoing process, isn't it? There's no end to it. It's continuous. You can keep on improving that.
Absolutely. It's one of these things that should be a central part to your overall risk management. Risk management is a consistent process, and it does always need to respond to how the landscape moves over time. You sometimes need to put a project in place to do compliance with a new piece of regulation, or a bit of regulatory focus, and that's fine. But the end goal should be not how do I achieve compliance. The end goal should be about how do I get compliant processes embedded in my normal day-to-day processes. Which, to be fair, is where a lot of organizations get it wrong, right? Because they
Yes.
see the compliance as the end, rather than the means to something else. And it's understandable, because sometimes there's an awful lot of regulatory changes that are thrown at our clients.
That makes sense. And thanks a lot for sharing all that information. And I hope you've answered a lot of questions that the stakeholders might have with regards to specifically these principles of model risk management, the supervisory statement from Bank of England. In terms of if somebody wants to learn more, and sort of what are the resources that they can refer to if they have any more questions?
Yep. So we'll be providing some links attached to this recording on our website, I believe. And we will have several articles to go alongside that. So we know there's a lot of information that's quite readable in the supervisory statement itself. But we will have a couple of thought leadership papers of our own, and we'll provide all the links of that together on the Aligne.ai website.
Perfect. And thanks for that. And this, I think this session was great. You shared a lot of insights into this. I know it's quite a long document to go through for somebody, and you're familiar with the subject, and you're already doing this for various clients of yours. And is it okay if I share your LinkedIn profile link in the description, so that if anybody wants to get in touch with you for their specific questions related to their unique challenges they're facing in their organization, then they can contact you via LinkedIn?
Yes, absolutely. I'm happy to do that.
Perfect. Thank you so much. Have a great day.
Thank you.
That was a very insightful conversation covering the supervisory statement issued by Bank of England, covering model risk management principles for banks. It's also called SS1 23. It comes into effect from May 24. I hope you found value in this conversation, in this podcast episode. And if you did, hit the like button and subscribe to get notified of our future episodes. Do leave a comment, and also if you have any questions, you can ask them through the comments, or get in touch with Aligne, or you can connect directly with Dennis or myself on LinkedIn. I've shared all the links in the description of this video. So thanks again for watching, and see you next time.